There's a lot of controversy about how carried interest should be treated by the tax code, and that's the focus of this Economics 101 video from the Center for Freedom and Prosperity. Hi, I'm Miriam Roth, and we're going to cut through the jargon and explain what's really going on. First, let's make sure we're all on the same page. The most important thing to understand is that we're basically talking about what happens when a partnership is formed to invest money. As you might imagine, such a partnership exists because the parties think they'll be more successful working together. In other words, they each bring something to the table. In the examples we're looking at, one party has money, but no special investment expertise, while the other party has expertise in making and managing good investments, but not a lot of money. So they strike a deal. The investor puts up cash and pays the manager to make what will hopefully be wise investments. As a quick aside, this process is good for the rest of us. When money is invested, that means more jobs, higher wages, and additional wealth for the economy. All economic theories, even socialism and Marxism, agree that capital formation is a key for long-run growth. So, we should be happy these partnerships are being formed. Back to our example. The folks who manage the money in these partnerships traditionally get paid on the basis of how much money they're investing. But since the person who's providing the money wants to encourage profitable investments, there's often an agreement that if the underlying investment rises in value, what's called a capital gain, then the investor will share a portion of that gain with the fund manager. The share of the capital gain that goes to the fund manager is called carried interest. Now we get to the controversial part. Under current law, carried interest is subject to the capital gains tax. This is a form of double taxation, since the income generated by the underlying investment already is taxable. But at least the partners only have to pay the long-run capital gains tax if the investment is held for at least 1 year. By the way, in a good tax system, there is no capital gains tax, but that topic was covered in another video. All you need to understand for today's discussion is that a capital gains tax is imposed on both the portion of the capital gain that is retained by the investor and on the share that goes to the manager. Seems pretty straightforward, right? But some folks on the left say that the capital gains assigned to the person who manages the money should be taxed as what's called ordinary income rather than as capital gains. Their argument is that capital gains tax treatment should only apply for people who provide capital in a partnership. They assert that the fund managers provide labor and that the so-called labor income should be subject to the regular income tax. That's apparently a persuasive argument for some politicians, but let's use an example to explain why it's wrong. Imagine that you and a buddy decide to start a company. You and your friend have different circumstances. Your buddy may have a regular job and no time to focus on the new business, but he has $100,000 that he's willing to risk on a new venture. You don't have any cash, but you have lots of free time, so the two of you decide that you will provide sweat equity and actually run the business. You both agree that's fair and you each get 50% ownership. Now let's imagine that the business becomes successful. Maybe you came up with some good software and some high-tech company wants to buy your small operation for $10 million. The two of you are a great American success story. But now you have to deal with Uncle Sam. So let's figure out the tax implications. Keep in mind that you've already been paying tax on annual income generated by the company. The question is how to handle the $5 million that each of you get from the sale. Should your buddy pay the capital gains tax rate because he provided the capital while you pay a higher income tax rate because you provided the labor? That would be absurd. The fact that you contributed labor and helped an asset grow in value doesn't somehow turn a capital gain into labor income. Yet that's the basic argument of those who want to eliminate what they call the carried interest loophole. The advocates of this tax hike appeal to base emotions by talking about sticking it to wealthy hedge fund managers, though even their demagoguery is sloppy since private equity partnerships are far more likely than hedge funds to generate carried interest. So what's the bottom line? First, there shouldn't be any capital gains tax. All good tax reform plans, such as the flat tax, get rid of this self-destructive and anti-competitive form of double taxation. Second, let's be honest about what's really happening. Revenue-hungry politicians in Washington want more money to spend, and they see carried interest as the camel's nose under the tent in their campaign to impose higher taxes on all forms of capital gains. That would be bad news for America's economy. That's why I hope you'll help the Center for Freedom and Prosperity by sharing this video widely. An educated citizenry is our best defense against tax illiteracy.